45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
All right. Cheers, everybody. Welcome to our Q2 investor call for Marshall Reddick Mortgage Fund. Patrick Prunty here, yours truly, again for the 22nd quarter since inception, and always my pleasure to be with you. I'm here in our Newport Beach office. Many of you know we've got multiple offices around the country now, but nothing better than Newport Beach where I am here today. So thanks again for joining us. We've got tons of value in today's program. And of course, it's always a pleasure to have a good, solid, profitable quarter to speak about, but a lot of interesting things happening in the market too, and some new news that I'd like to share. As I mentioned, my name is Patrick, so contact information hasn't changed. Most of the folks on this call I know or have spoken to, but we also have some new folks on the call tonight, and I'm excited about that. I always love bringing new folks into the program. I'm a big investor in this fund, as are a lot of our staff, and that's really important to me. So we're going to go through a lot of the stuff that we always do, and again, have some new things. We'll get into a little bit of the basics too for those new folks who may need some clarity on exactly what Marshall Reddick Mortgage Fund is and what it does. Unfortunately, I'll be running this presentation on my own tonight. Our close colleague, Vince Tomich, has got some family issues and wasn't able to join me, but Vince is a wealth of information. Everything's okay on the home front for him, but he just wasn't able to be here with me this evening. But many of you who know him know that he's a wealth of information when I'm not available, because there's a lot of you folks today. And while I'll make time for you, it might have to be on the schedule. But Vince is more readily available to take some of those calls, to get into some of the details, to help you invest more capital, or to invest for the first time if you've got questions that need to be answered. So again, take note of his contact information, and by all means, don't be a stranger. Please reach out to him. On that same front, I'd like to mention Kaylee Lee, who is just, she's just so good. She's so good to us internally. She's so good to all of you guys, our capital partners or soon-to-be capital partners. She's our fund accountant. She's got a tight bead on the accounting. And, you know, I can't encourage you enough. If you have investor relations or questions about the accounting, or about your statements, or about redemptions, or about capital calls, or any of those little things that we all have questions about, Kaylee is here and happy to help you, right? And I just want to give her just a big shout. Thanks so much, Kaylee, for everything you do. We couldn't do it without you. With all that said, it's an honor and a privilege. I mean, I take great pride in what we do here at Marshall Reddick. I've worked for Marshall Reddick 22 years now. Crazy to say, and I say that a lot, but I just am blown away every time I think about it. But I love what we do here. I especially love the mortgage fund, which is like one of the brainchild that I had, that was born out of this private lending program that we started more than 15 years ago. And I just love it because I get to help clients like yourself make money, doing so safely and securely. So again, thank you so much for the opportunity to be of service. I'd also like to throw up a group email that we've set up, MRMF for Marshall Reddick Mortgage Fund at marshallreddick.com. This is monitored by several people and is a great place to reach out for if you have information. Kaylee that we talked about, she's on this, and you will get the quickest, fastest response with anything you need related to our fund by using this email. Okay, quick updates, right? As the marketing stated, the results are in. We've been fast at work reconciling since the close of the quarter, which happened on June 30, and the new quarter started on July 1st. So as of July 1st, we always post the numbers effective of the first of the next quarter. We have 71.19 million in investor capital at this point in time, and that's another huge milestone. Super proud of that. Rewinding all the way back to 2020 when we launched this fund and we had zero capital. Our goal was to raise 100 million, and we're well on our way. And most importantly, we're able to keep this type of capital working, and working safely at good yields with few, if any, defaults, so that we can keep paying a good return to you and all the capital partners, including me. and the rest of the staff here at Marshall Reddick who is invested in this fund. We're up over 337 capital partners now. We weren't sure how many it was going to take to get to that 100 million, but we figured someplace around 500. I think we're going to beat that number. And I think a lot of that has to do with a lot of folks getting really comfortable with what we're doing. I know I certainly am, and getting into that 6-7 digits of capital invested for one person. And we've got some increased capital partner splits that we've had for a while now. I'm going to be talking about those when it comes to return on investment. But this is a great number. This means that a lot of folks, just like you, for those new folks listening in, have decided that this is a good diversification strategy, something that they can put into their investment portfolio and that they can count on quarter over quarter. Of course, we're at 5.5 years since inception now. That's 22 quarters, and we've been profitable in all 22 quarters. As we've talked about a number of times, my colleague Ross, who is heavily involved in the setup and the ongoing management of this fund, it's our intent to just go 100 straight quarters without missing a profit and then beyond. So if you haven't already invested, you should join us for safe, passive cash flow, because that's exactly what Marshall Reddick Mortgage Fund is. It is cash flow that you can count on. Okay, there's no shares, there's no appreciation, there's no tax write-offs. This is the straight fixed income play that, although is a little bit different every single quarter. No 2 quarters are the same. They're all slightly different, but there's a very tight range of returns when it comes to a percentage based on capital. I'll get into all that. So we talked about the total investor capital by quarter, and I've got just a little graph on the screen, and this is just to show the consistency in which we've been raising the capital since inception over those 22 quarters. And we don't want it any faster than this. We want to be able to take in and deploy the capital. Right? We've got this weight room. A lot of people are always asking about the weight room and our need to hold folks when they first invest and they subscribe. That's always at top of mind for someone like myself, who's at the helm every single day. But this is a good, comfortable capital raise, and we're going to continue this up to that 100 million. And then once we get to there, we're going to reevaluate where we're going to go. We potentially could go higher than that, or we could maybe open a second fund. There's a lot of things that are in the works behind the scenes, but all for your benefit. As far as number of investors by quarter, right? We talked about over 337 now. Again, similar type trend line here, in just a slow, methodical capital raise. Investor raise. So as capital's going up, so is the number of capital investors. And these numbers that I'm showing, these are net numbers, right? So this includes those folks who have redeemed. So folks who have redeemed partially, they would still be an investor. If they take a full redemption, they would not be counted as the investor count. I should have said the same for the capital as well. That 71.19 that we ended up with on July 1st, that is a net. So that includes those folks who have redeemed over time over the last 22 quarters. And that is something that's important to understand in any investment that you make. Is there a path to liquidity, and what is it, and how do I get my capital back in the event I need to, right? So we're happy about our liquidity, driven mostly by the fact that we're hyper-focused on 12-month loan terms or less, which means that after 5 years of doing this, we've literally got loans paying off every single day. And with that liquidity, we're redeeming folks that need to get out. Honestly, we don't have a lot of folks that are getting out, especially right now where people are trying to reallocate their portfolio and figure out what they want to do. Big indicator of that is CD rates and money markets have started to come down. Right, they were at the peaks of 4.5–5% a year or two ago, and those are now down at the 2–3% range, perhaps even lower. I know my accounts and our business accounts are experiencing that same dynamic. So because of that, people are looking for a safe haven and place to put their money. And while we're not FDIC insured, we are backed by real estate at a very favorable loan to value. And so in my opinion, as a real estate guy, and has been for my entire career, I think we rival the safety of a bank CD. Okay, so let's talk about those Q2 earnings results. Everybody that was dialed in got the emails that I released on Friday, as we usually do on that Friday of the third full week following quarter end. And so the numbers panned out to be at 2.51%. That's fund level earnings. That's pre-profit split, okay? And everybody has a profit split with management. But that's net of expenses, right? So all of our expenses, including the management fee, including our servicing fees, including our legal and other types of expenses. So 2.51% for the quarter, that annualizes out at 10.4%. So interesting thing here that I just loved was the fact this is the first time we have distributed more than $1 million in preferred returns. Certainly won't be the last, and I hope that every quarter from here on out is north of 1 million. That leaves, of course, the remainder to be split. That's the 666,505 that was profits above and beyond preferred return that are split, again, with management at varying different levels based on your capital account. So I have had some people over the weekend reach out and indicate, hey, the 2.51% was a bit lower than it was last quarter. That's correct. Every quarter is a little bit different, but again, a very, very tight range. So with that in mind, I wanted to just simply show over our 22 quarters since inception, what has that net of expenses fund level return look like? Okay, so to the far right, you can see that the prior quarter was 2.59, even the prior quarter before that, Q3 of 2024, at 2.58. So we did drop a bit there at 2.51, but still a very, very solid performance and one that we as a team are extremely proud of. Okay, but just to understand what the range looks like here, very tight. And that's why you can consider this sort of like a fixed income type investment. Certainly the loans that we're making, they're fixed interest rates. And so while each quarter in terms of net income that's distributable is slightly different, it's on a very, very tight range, which is why we've all come to realize that we can count on this check, this investor check coming at the end of every single quarter. Okay, so with some of that information that I know folks want to get right out of the gates, especially for all those folks that are current existing capital partners. But for those folks that are new or that are exploring or like, hey, I'm not sure how I ended up here, but I'm curious, tell me about what is Marshall Reddick Mortgage Fund and need a little bit of clarity. Let's back up a little bit. Okay, so in order to understand what Marshall Reddick Mortgage Fund does, you must first understand what our private lending arm does here at Marshall Reddick, which is the department that I lead. Okay, our team is growing, by the way. We've got 15 members now, and we're super excited about that. Always looking to add good new folks to the team. So when it comes to private lending, we're very, very strict on what we do. Absolutely 100% non-owner occupied, short-term loans only. We dabbled with a little bit of longer term earlier on in the fund's existence, and we learned quickly that those were not going to be good for the bottom line. So while we will do some bridge loans in the midterm, up to say 36 or even a maximum of 60 months, we're hyper focused on loan terms of 12 months or less. Okay, first lien only, you must know that, right? Do not lend in second position. It's not a good place to be, even at a good CLTV, which is a cumulative loan to value. You've got to have that good loan to value. That is your safety. The more borrower skin in the game you have, the better you're going to be, right? So the lower the loan to value, the better. These loans that we make from our private lending team are designed for the experienced real estate investor. Okay, doesn't mean that we don't lend to first timers, but we take that into consideration heavily, and we will ask for a larger down payment. We'll probably charge a higher interest rate to first timers or those without experience in this space. No matter what, we're always secured against residential real estate, and we love single family homes. That comes out several times in this presentation. You guys heard me say it for years. That's just what I know. As a rental property owner, as someone who's flipped a bunch of properties myself over the time, who has done just about everything you can imagine in the residential real estate space, single family homes are just the most easily valued, most easily managed, most easily disposable. And that's important when it comes to the lending side in case you get into trouble with a borrower default. Okay, so that is what we do from a private lending perspective, which is then I will introduce, what does Marshall Reddick Mortgage Fund do and how does it play into that? Well, all that Marshall Reddick Mortgage Fund does is fund loans for Marshall Reddick's private lending program. There are other options to fund loans, and we get our capital from other sources, but that is all that Marshall Reddick Mortgage Fund does. It does not buy loans from other locations. It does not fund loans for other brokers that are underwriting and originating. It all coming through in-house with our own underwriting and our own guidelines and our own decisioning of every loan. But on the fancy level, we are a Reg D 506C private fund managed by yours truly, Marshall Reddick. So it's important to understand, Marshall Reddick Real Estate is one business, Marshall Reddick Mortgage Fund is another business. Marshall Reddick Mortgage Fund doesn't have employees. It's all run and managed by Marshall Reddick. Like myself, I'm an employee of Marshall Reddick Real Estate, and a lot of my time and effort goes into managing the affairs of Marshall Reddick Mortgage Fund. Okay. This fund operates in perpetuity. It's not like a lot of real estate syndications that are out there where you have a period of time, say 3, 5, 7, or 10 years where you're going to invest the capital and it's going to be locked up. It's much more liquid than that. So our fund doesn't have an end date and it has no end to the capital raise. We're always raising capital. We're always giving capital back. It just depends on the market. It depends on the sentiment. It depends on the economic times. It depends on the demand. Okay. So our waterfall is very simple, and it consists of a preferred return and a profit share. Profit share does vary based on your capital stack. We'll get into that. There are no load or investment fees. So if you invest $100,000, your capital account is credited with $100,000. There is, however, which is very common, an asset management fee. Right? That's not a profit center, but that's what goes to pay Marshall Reddick Real Estate for all of the staff that it pays to arrange the affairs and run Marshall Reddick Mortgage Fund. Okay, so 100% of net income is distributed quarterly based on your percentage of ownership. So like I said, as of July 1st, we had 337 capital partners, and they all own varying percentages of the total. Okay, but when it comes to that end of the quarter, we're going to waterfall across, and everybody's earning the same maximum percentage, which is based on whatever that net income is that we're going to distribute. Right, it just then depends on the preferred return, which we all have at 6%, followed by your share of profit split. And as I mentioned, we're strictly funding loans approved and fully underwritten by Marshall Reddick and the staff I manage here in our Newport Beach office. Okay, the fund has a $25,000 minimum. For reference, my top capital partner has a $5 million position. It's a 12-month minimum hold, so if you're going to make the investment, whether that's at 25,000 or 5 million, you know that you're going to hold for at least 12 months. After that, you're not signing up for perpetual 12-month loan terms. I like to call it a month-to-month lease thereafter. So you can call for your capital after the 12 months if you like, or you don't have to. You can let it ride. You can add more if you'd like. You can redeem some if you'd like, subject to maintaining the minimum of 25,000. Okay, so it's really important to understand that good liquidity, the ability to get out when you need to. All right, as I mentioned, it's made up of a 6% preferred return. That is the hurdle that the investors must receive from an annual standpoint. If you break that down quarterly, that's 1.5% per quarter before management can partake in any profit share. And we're in business to make money, just like every business is in business. And so we're out to perform, to pay you the preferred return, and then we can get to the profit share element. So we can pay you more and we can pay Marshall Reddick. All right, so a really important topic here is the ability to reinvest or take the earnings in cash every quarter. So if you need the cash flow and you want to spend it, no problem. We'd be happy to send it to you. That would be taking the cash at the end of every quarter. However, if you don't want it and you want to compound your returns, or specifically if you have a self-directed retirement account, this is key, especially compared to direct lending with Marshall Reddick, which is the ability to reinvest the earnings. And that is absolutely huge, because I find a lot of times people using that self-directed retirement account, they don't know what to do with it. And then they start liking private lending and they see that it makes sense, but they don't have anything to do with the monthly payments that they're receiving if they own the loan directly. But if you put the money into the mortgage fund, you get your quarterly earnings, you don't take it in cash, it just automatically goes back onto your capital account and allows you to earn on your earnings. It is brilliant. So for those folks with self-directed retirement accounts, this is something that you should look at heavily if you're not fully invested elsewhere. Or as you have liquidity events in that retirement account, you should give Marshall Reddick Mortgage Fund a look. Again, it's a minimum of $25,000 and it's only a 12-month minimum hold. As I mentioned, there's no UBTI, that stands for unrelated business taxable income. This is something that would be in place if there is leverage. Okay, I won't get too into detail of that right now. We are an unlevered fund. That's very important. At some point in time, we might bring on leverage because as the fund grows, it's getting a bit more difficult to manage the daily cash flow. With so many loans paying off and so many loans funding every single day, so many construction draws funding all of the time, it's healthy to have a small credit line to manage that cash flow. But we haven't done that, and we won't do that while we are still in our status as a private placement. The only opportunity to be able to do that would be with the addition of a new fund where everyone is aware of the leverage, or if we convert to a REIT, which we all know, or if you didn't, I'm giving you the information. The Big Beautiful Bill did extend the QBI tax deduction that we personally had been waiting for to make that conversion to the REIT, which is a real estate investment trust. Now that that has passed and been extended, it was previously set to sunset at 12/31 of this year. It's now been extended, and so now it's full bore ahead. So I think you might see the REIT structure for Marshall Reddick Mortgage Fund sooner than you think. Okay, nonetheless, moving on, you must be an accredited investor. Okay, and I won't get into all the details of accreditation right now, but you've either got to have high income or high net worth. And I'm hoping that they're not going to change those rules because they're not the same as they used to be, right? Or at least money isn't the same as it used to be. But from an income standpoint, you've got to be earning $200,000 per year as an individual, $300,000 if you're using spousal income jointly, or you have to have net worth of greater than $1 million, excluding any equity or debt in your primary residence. So again, somebody like Vince, somebody like Kaylee, or the other professionals at Marshall Reddick can help you navigate that if you're a new investor looking at getting started with us in an investment in this fund. So I talked about the REIT, that might be coming sooner than later, but currently, and as for the 2025 tax year, we are still a California partnership distributing a K1 annually. Okay, now, so we've got the earnings out on the table. We've got the basics covered. Again, let's get into a few of the topics that we're going to try to dive into. And of course, there's only so much time on these investor calls. I'll get as detailed as I possibly can. But if I don't answer some of your questions, I would love the opportunity to speak to you. I'm here in the Newport office all the time. If you're local, please come in and visit us. We'd love to have you see our operation, meet our team. If you're not, we can always do a Zoom call, or we can just do a telephone call if you don't get any of your questions answered, or you have other specific questions and you'd like to get really granular. We'd love to talk details. So we're going to get into return on investment, uncertainty, and underwriting. That's the top of mind for a lot of folks. We're going to get into the specifics of Q2 and a bit on what's ahead. I'm going to start with return on investment, as there always seems to be like a little bit of confusion about that when I'm releasing the letter and what's the fund level return and what's my split and what's all the capital and all that kind of thing, okay? So I've got a screen clip here off the website. And when I say the website, we have a specific site. Please take note of this. URL at the bottom of the screen, marshallreddick.com/MRMF. This website is updated all the time, okay? Sometimes in real time based on loans that we're funding or loans that are paying off, and you can get a really, really granular look into what our portfolio is, right? The assets that it's secured against, the loan to values, photos of the properties, budgets, appraisals, all that kind of stuff is there. But we also update it once a quarter based on our returns and our capital. But specifically, there's this 8.53%. This is a since inception return on investment, and people get confused by that. I understand why, and we're working with our software developers, and we're hoping to bring some clarity to this site, but I'm going to do so now for everybody on the call. So when it comes to the return on investment, and I've taken another screen clip from our website, that same site that I just mentioned that talks about since inception, as well as the 1 year, 3 year, and 5 year returns. Again, this is as of July 1st, okay? Again, these returns here are based on our entry tier, Remember, the minimum is 25,000 and the entry tier is 25,000 up to a $500,000 capital account, which means that after your 6% preferred return, you will split the profits thereafter 50-50 with management. So that 8.53% on the website factors in that you've invested with us since day one. That's me, a lot of you as well. And that you have the entry level tier, the 50-50 profit split, and you've reinvested the earnings and you've been compounding since day one. So take that for what the number is on the website. But let's get a little bit more granular now in terms of what does that look like if you're in the higher tier, or if you're looking to get into the higher tier as you've become more comfortable with our operation and how we do things. So the tiers are as follows, right? Again, under 500,000 is a 50% split, again, beyond your preferred return. 500,000 up to 3 million is a 60% share of the profits, which means that management's taking a little bit less. So that's a 60-40 as opposed to 50-50. And then our highest split is for capital accounts north of 3 million. Okay, and so that would be a 70% split of the profits, meaning 30% to management. Okay, so these are based on your capital account, again, after the preferred return that we all are earning at 6% or 1.5% per quarter. So I don't want to get too detailed on you here, but it's important that you share the numbers because I'm a very detailed person. So what I have here is I have a graph on the left-hand side, varying dollar amounts that would be hypothetical investments that you can use to run these numbers. So 100, 500, or 3 million. These would represent our 3 different profit split tiers. So the net income from quarter 2, right, and I'm running these numbers based on quarter 2's numbers. These are real numbers. That if you had your corresponding investments there on the left at 2.51%, the income earnings applicable to your capital account would be there in the net income column, right? 2,510, 12,550, 75, 300. Of course, preferred return, we talked about, that's 1.5% a quarter. So that's what you'd get there. So then we're taking the net income minus the preferred return to get to what's the total profit split that's there to be split between you and management. Then based on your profit split tier, 50, 60, or 70% in the profit split column. And then we're just adding up your preferred return plus your share of the profits to getting to the total return. And then that's in the quarterly return column. And then we're annualizing the numbers out just by multiplying quarter 2 by 4 quarters. Remember, every quarter is a little bit different. They won't be the same, but still for educational purposes and for visual purposes, we're annualizing it out in that capacity. So I hope that's helpful and brings some clarity. Taking a step further, we talked about the 8.53% number on the website. That's our entry level tier, and that considers earnings reinvested and since inception. So if you had invested with us since inception, right, over all 22 quarters, and you had been reinvesting since day one and not taking, and you were at these corresponding profit split tiers, your total return would be here in the right. And so what you're learning about this is that each profit split tier, so each extra 10% of the profit that you get, represents about 50 basis points per annum to the bottom line return. Okay, 50 basis points being 0.5%. Okay, Q2 was solid. Very proud of the results that we had. And while we've had 22 consecutive quarters, I think we're all feeling a bit uncertain. I don't know how much of the news you watch. I try to not watch too much of at least the nightly news. It's a bit scary. My father, he's a news guy, and he's always telling me about it, so I get enough of it from him. But nonetheless, it's not funny, right? We all should think about it. I know you guys are all thinking about it. I certainly think about it every day, considering that you've entrusted me and the team and Marshall Reddick and our loan committee and all of those putting all the time and effort in to manage this fund and your capital and to pay you good returns. We're thinking about all these metrics and a lot more, I think, than you're thinking about on the regular, as they are important. So the big question here is, well, how is Marshall Reddick Mortgage Fund continuing to deliver safe and strong results and strong returns? So the answers, you know, there are many. I boil them down into like 3 buckets, and each bucket has a number of different criteria. So I talk about right away, it's secured debt. We don't make any loans that don't have real estate as collateral, right? No matter what, I'm not losing the money. I'm getting the real estate at a minimum, okay? First lien, which means I'm getting the real estate. Don't want the real estate. I mean, things could be worse, of course, but and of course I'm okay owning the asset if I have to. I just don't want to have to go through that process unless I have to. But by lending secured and lending in first, I am assured, due to the title insurance, that I'm getting that asset and nobody else. So I am in primary power control position, especially if I have a good loan to value, right? And at the end of the day, I don't want to take anybody's real estate, but they signed up for this loan. They have a down payment. They have equity at risk, right? And I am, I give people a little bit of a leash, right? I try to work with everybody on loss mitigation, but I've got some hard and fast rules that it's just time to lawyer up in the event you can't maintain your debt service. Now, the good news is the absolute lion's share, and I'm talking about 95, 96, 97, 98% on a fluctuating basis of borrowers are making their payments on time, not even close to a 30-day late. We do have some periodic that we'll get into, maybe one or two past due, but it's very uncommon that we get into a situation where we've got more than 3 payments past due. And a lot of that has to do with the fact that we've got a good LTV. They've got a lot at risk. Good assets, good locations, and a low average loan amount. Okay, so I mentioned one of the major things that comes to the final decision on the loans that we are going to lend against, or the properties that we're going to make loans against, is the asset, right? Good school district, good location, good geographic market, well-diversified market in terms of jobs and population and other things of that nature. And at the end of the day, it's, you got to be okay owning that asset. If you're not okay owning it, you shouldn't be making that loan, okay? Because again, that's our worst case scenario, is we are going to have to take back that asset and then either fix it up, dispose of it, or any number of different things. Good locations, mentioned that, right? And so a lot of that boils down into, like, where's the subdivision in the local geographic market? How's the lot set up? What's the school district look like? There's a lot of different factors that go into all of that. But we are hyper-focused on good assets and good locations. And I think the average loan amount is something that a lot of folks don't consider when they think about the risk of Marshall Reddick Mortgage Fund. We've got, north of 270 assets in the portfolio, and that number is sort of going up and down, generally on an upward trend. And the bottom line is that our average loan amount, I'm going to show that a little bit later, is around $300,000. So that is starkly different from a lot of our competitors who are like West Coasters, right? Our geographical footprint is a lot in the Midwest and a lot in the South. Property values are much lower, right? Much more in line with the national average in terms of median single family home sales price, right? So at the end of the day, we're going to have our share of problematic loans. Everybody does. It's part of being in the lending business. But if we get a default, a nasty one where we've got to go through foreclosure, and we had a couple of those, I'm going to get to that, but they don't have an effect on the fund, as opposed to if I had a $5 million loan that went bad, right? That might blow a hole in the fund's yield. So I really like the fact that our average loan amount is very low, and we're very conscious of that too. We don't want to over lever the fund on any single loan, on any single borrower, on any single capital partner either. And then it comes to diversification. Lots of different borrowers, lots of different states. Okay, good states, and you'll find that a lot of the concentration of loans that we have revolves around locations where Marshall Reddick's got its own office. So heavy Texas, heavy Florida. Although we've been very cautious about Florida. No secret, Florida's been on a slide, as are some other geographic markets, right? But we're in tune with that, and we're watching closely. We are spread out in other markets that we like, that are good, that are solid, right? And so it keeps that diversification. I think the other two items that I'd like to mention about how MRMF is continuing to do what it is doing and produce the results that it is producing is that we're not gouging people. It's a very competitive lending market that's out right now. And so we keep our rates and terms really competitive. But we do that on purpose. We do that because we want to attract the best borrowers looking for this private capital, these bridge loans, these renovation loans, these new construction loans, because people have a lot of options, okay? So we need to be competitive to attract the best, most qualified, most experienced talent, as opposed to the opposite of that. So while I probably could try higher rates, right? And I know there's a lot of investors thinking out there, I'd really love it if you could raise my yield. Well, for what kind of risk? That's the question you have to ask. And I really like our track record. And I really think for the risk that we offer, our return is pretty darn good. So that's the competitive rates and terms. And what does that do? That stems into repeat borrower business. So most of the loans that we're making, especially at the fund level, where I'm cherry picking the best of the best loans out of all of the loans that are being originated in Marshall Reddick's private lending pipeline, we certainly aren't funding them all. I've got this whole other side of the business that's the direct lenders. And that doesn't mean that the loans that I'm making, that the direct lenders are making coming out of here are bad loans, right? That just means for some reason, either I didn't like them or the loan committee didn't like them. There was some little metric right there that was a little bit off, or we were just flat out of capital, right? The mortgage fund goal is to have 100% of the cash deployed every single day. That's going to help us keep yield high. So these would be the bullet points and the answers that I would give to answer this question. Okay, let's talk about the uncertainty. Let's talk about the market a little bit. So absolutely, I think we might all agree here that the housing market has been strong and resilient over the past decade. But man, since those interest rate hikes that occurred in 2022, everyone's been a little bit like, right? And we haven't really seen everything play out from that yet. But I think we're seeing it now. Okay, so it's certainly hyper local based on geography. But I think the market has softened in a lot of markets, not all, right? My location where I live in Southern California, a nice house comes on the market, priced reasonably well, multiple offers right away. But you take that, and of course, then you go to say someplace like Southwest Florida, overbuilt, too much inventory on the market, distressed sellers, right? That have high, long carrying costs, long interest carries, property taxes, high insurance costs, again, hyper local, right? So, but nonetheless, I'm seeing the softening in the market, okay? And in some markets, a bit of a slide, as I mentioned, Southwest Florida, okay? That's not the only market. There are others, but we're in tune with that, right? And again, I'm talking to people all over the country every single day, borrowers, lenders, attorneys, capital partners, CPAs, you name it, right? I'm working with those types of professionals in my network, and that is where I'm getting a lot of my sentiment from, besides the fact that I'm a real estate investor myself, and I'm always looking for good deals, right? Especially in the Tennessee, Texas, and Florida markets. So nonetheless, it's standard operating procedure for us in times of uncertainty, which we seem to have found ourselves in now. We obviously can't stop doing business, right? Everybody's got to keep pushing forward, but you do it a little bit smarter. And somebody like myself, who's been around in this space for the last 22 years, I've been through 2008. I know what can happen. And so immediately when all these different things happen, it's like COVID happened, when the interest rates started happening, right? Presidential changes started happening. I'm always tinkering with the bottom line. I'm always tinkering with the guidelines. And so there's no secret that's what we're doing right now. So if we've got a borrower coming and they've got a reasonable deal, they all want the lowest down. They all want the lowest interest rate. But we're making them look at each deal a little bit harder. We're asking them to put a little bit more down, okay? We're willing to give up yield a little bit for safety, but we always are looking for that good loan to value and that good equity. Okay, and we're concerned about how many loans that each borrower has out with us, especially when it comes to the fund, and a lot of those other metrics. So just understand that as this market uncertainty continues, right, whether that's housing and any other sector that's out there, we are constantly tightening up those guidelines in an effort to keep our loan to values in line, in an effort to keep this fund as absolutely safe as possible to continue to produce the results and the returns that you've grown accustomed to over the last 22 quarters. So, as I mentioned, problematic loans are a part of lending, and we will have borrower defaults. We have had those. I think historically, Marshall Reddick's funded something around the 4,000 total loan originations in the past 15 years, and we've got a little bit more than 60 total loan defaults. Okay, but we had a couple that worked their way out in the second quarter, and I'm going to dive into that. But it's just something that I wanted to share with everybody, right? We're not going to bat 1,000, right? That never happens. We don't shoot 100% from the free throw line. Nobody does that. We just have to manage risk accordingly, and we have to have our fund and our accounting set up correctly to be able to absorb those credit losses if they occur. Okay, so one of the things I like to take away from here, we've got a QR code. Use your mobile phone if you want to do that. That's just going to take you to a place where you can reach out to Marshall Reddick. Okay, we're all in this together, and a lot of times people just want to talk, right? So we would love to talk with you. There would be an advisor that will call you back, email you back, communicate with you, whatever medium that it is, right? But in times of uncertainty, if you want to talk about the fund, if you want to talk about your real estate portfolio, if you want to talk just about the market, we'd love to talk. Okay, so don't hesitate to reach out to us. We're here for you. All that I've said so far, with certainty, and I'll say that again, with certainty, I expect the success of our fund to continue. Shadow of a doubt, right? We're very well diversified, and even if we have our share of problematic loans, we've got a loss reserve for that, and the majority, far majority, are very solid loans, very good loan to values, very good assets, with on-time monthly payments, solid exit strategies, and we are very happy with what we're doing at the fund level. Okay, Q2, and I love getting into this. This is one of my favorite parts to share with you guys each quarter. So we originated 54 loans going out within the quarter for $18.5 million. Average loan amount of $343. So the average loan amount's ticking up a little bit, but so is our overall capital stack. Again, we're over 70 million now. Okay, very important two metrics here: weighted average interest rate, weighted average loan term. So I would love to have the highest weighted average interest rate possible and the lowest average loan term. Loan term is important because that means that there's a maturity, and at maturity we get to do one of two things: we're getting the loan paid off, or we get to charge an extension fee and drive the yield. Okay, so we want the highest average interest rate and the lowest average loan term. But how do you really quantify that? I like to quantify that against the loans that are paying off. So we had 59 loans come in, pay off during the second quarter, right, for about 13.7. And that was an average loan amount, 232, paying off. And we had an average interest rate of 10.04 and an average loan term of 11.7. So let's compare those to each other, right? So we've got 13.7 in payoffs coming in that were paying me roughly 10.04, that were out written on loan terms of an average of 11.7 months. And I'm pushing out that same 13.7 plus new capital coming in at a 10.29% rate, so about what, 0.25% higher on the return on average, for what, almost a month shorter on the average loan term, right? That is the metric that I want to see every quarter. I want to see that type of gap. Take in at lower, deploy at higher. Hope that makes sense. Okay, let's get into the financials and some metrics. So I always show the profit and loss and the balance sheet. I always release those on the distribution memos that go out. They went out last week. I also publish those on that marshallreddick.com/MRMF. Look for the Q2 letter, and these same financials will be there in case it's a little bit small and you can't see it here on the screen with me tonight. Breaking that down, again, that's our 2.51 for the quarter, or 10.04 for an annualized based on 4 quarters at the same 2.51. Our preferred return represented $1,021,000 across everybody's positions. And then of course, we split our profits based on your capital account. Taking that a step further, just to add in and give the total per capital partner, and we saw these numbers previously. But again, they tie right to the P&L, and they will every quarter. Okay, let's move on to the balance sheet. And there have been some changes to the balance sheet. I won't get into too many of them at this time, but there's been a slightly different presentation look here. And where that's coming from is we're getting a lot of advice as it pertains to audited financials. Those probably coming sooner than you think as well, all right? But we are really getting ourselves aligned to make some of those big moves that we've been talking about. So when it comes to the loss reserve, right, 75,660.91 for Q2, you would actually see that on the P&L. It's over there to the right. I just backed up one. It's in the operating expenses right there above the management fee. Okay, that's going to be important. We're going to talk about that a bit. It's always been a topic of discussion, and it hasn't been certainly understood very much by the capital partner base, and I think it'll make sense more given the nature of Q2. Nonetheless, that represents 4.29% of net income. That expense, that's 75,000 in loss reserve. This is a non-taxable, tax-deductible expense to the mortgage fund and is a reserve for expected credit losses. Okay, this is what banks have to do. This is what audited funds have to do. This is what our fund is doing following suit. Okay, such an allocation is required for a third-party audit. Talked about that, and you can see the loss reserve as it accumulates in the allowance for expected credit losses. You can see that over here in this 306 number. There's also something else that you'll see over here, which is deferred loan fees. Okay, something else that we've learned about an audit is that we have to take in and we have to amortize our loan fees, the upfront points that we get for originating each loan. We have to amortize those over the term of the loan as if they were interest. So we're already strategically doing that as we build up towards our first audit. So the allowance for expected loan losses totals 306,641.56 as of 7/1, which is less than 0.5% of total investor capital. I'm going to be really hyper-focused on increasing that over time, so long as it doesn't affect yield. Okay, I had a lot of people read through my letter that I distributed on Friday and asked a lot of questions. Hey, Pat, you mentioned we encountered a few problematic loans. Remember, that's normal. We just happened to have 2 of them work their way out. These were some nasty foreclosures. They were isolated, Southwest Florida, Cape Coral to be specific, as you can see here on the screen. And we actually had to go through a strategic foreclosure, right? The builder, they went belly up. A lot of builders in a lot of areas are experiencing some real hard times right now. This particular case, belly up, right? We were stuck holding these 2. We had to figure out what to do, right? We would have disposed of them much quicker. However, there was a lot of mechanics, material men, service providers who had provided services to that builder and hadn't been paid. They had attached liens to the property. And so in that case, again, we had to go through a strategic foreclosure process, because through that foreclosure process, everybody gets notified and they get an opportunity to take out our position. Of course, none of them were willing to, and by law and legal means, their liens wiped clean. We end up with the property free and clear. That's the beauty of the first lien position, okay? So we ended up with the properties. They both went to auction on June 12th. One sold. Somebody came, paid cash for the asset right there on the spot. We priced it very aggressively. It was partially built and it was going to be a big undertaking to build it all the way out. And I didn't see the upside in doing so. So we priced it aggressively. And then the other one at 1517, it did not sell. So if you rewind back and you take a look at that balance sheet, you see an REO there. That is the value of that house. Per the BPO that we're required to get at disposition. The good news about that property is that we listed it for sale with one of our agents out of our Cape Coral office. We had about 15 offers in about 10 minutes of activating it on the multiple listing service, and we sold it in early July. So we've disposed of the asset already. And something I think that's really important to understand about what we've just talked about and some of these problematic loans that we encounter periodically is that we are very proactive here at Marshall Reddick. We don't sit around, we don't wait, we take action as needed, and we have the resources to make it happen. So both of these were losses, no doubt about it, right? Isolated, of course, and I don't have any more of those coming, at least that I can foresee now. And the cool part about what we're doing here is that the allowance for expected loan losses filled its purpose. Okay, so there was no effect to the P&L in this quarter, and there shouldn't be, right? The effect to the P&L has happened quarter over quarter over quarter over time, and allocated that credit loss reserve on the balance sheet. So those losses that we took to dispose of those assets, right, and get as much of the capital back as we possibly could, re-lend it out, get right back on the horse, start making that money back, it goes in and offsets that loss reserve. So I think now that we quantify that, I think that everyone that's always asking about what that loss reserve has a better understanding of that. And again, that's not something that Marshall Reddick does, right? Marshall Reddick Mortgage Fund does. That is an industry standard, something that is required of banks and other private equity funds just like ours. Okay, let's get into some of the other metrics that we get to on a regular basis as we wind down today. So our portfolio remains strong. 274 loans in the portfolio as of July 1st. It's gone down just a tiny bit since then. We've had a lot of loans paying off. It usually happens this time, sort of midsummer, right? Coming out of the spring selling season, we get a lot of assets that sell and then a lot of corresponding payoffs. But we've got a lot of capital and we're going to be deploying into a number of loans over the next 30 days. I expect that number to go right back up and continue its upward climb. Loan to value, our goal was always to stay under 65%, and we've successfully been able to do that. That's the biggest risk or measure of risk that I think is available when it comes to secured lending. I love single family homes, just absolutely love them, especially when it comes to lending money. And 75% of our collateral, the 274, are single family homes. All right, 80% are on loan terms of 12 months or less. And we continue to be hyper-focused. I had a number of people ask me about the P&L this quarter, and they noticed a small negative in parentheses up in the revenue line items for loan sales, right? We did sell a couple of loans. These are long-term loans that we've been holding, performing just fine, but that tiny little loss, right? We did the analysis on it to say if we got that capital back and lent it out at higher interest rates with shorter terms, we're going to make that money back significantly faster and then be in the red or in the black thereafter. So that was a strategic move as we continue to stay hyper focused on short-term loans that allow us to turn the portfolio. That's also a risk avoidance and mitigation mechanism. Turning that portfolio over and over every single year allows us to reprice the interest rates. It allows us to charge origination fees. It really is a safety mechanism as well as a ability to reprice the debt that we're making. Our core focus, we're in about 20 states, but some of them are just like randoms in terms of like a really good deal that popped up. Otherwise, we really got a core focus on 15. Florida is still one of them, but Florida is one of those that's been up on our radar for the past, 6 quarters. 8 quarters or so, and you've noticed that we've been bringing down our loan count and our loan volume in Florida. So unless it's a slam dunk or a grand slam or whatever your favorite sport is, we're not making that loan in Florida today. Average loan amount continues to tick up a little bit, and this is for our total portfolio, around a $300,000 loan amount. Again, very favorable number given the number of assets that we have, and especially given the size of our fund, where a lot of our competitors, they'll be like, oh my gosh, how do you manage so many loans? I'd much rather have so many more loans to manage than have 70 million spread across, say, like 70 or 80 loans or 100 loans, right? That's risky, right? Because you get that small number of defaults or problematic loans, and you can have a significant effect to your fund, and even so much so that it exceeds the allowance for expected credit losses. So we talked about the 337 capital partners and the 71 plus million. Just something else I love, and I mentioned this in my letter from last Friday, more than 10%, or it's been 10% since inception of internal staff at Marshall Reddick is a part of that capital stack. So our team here just absolutely believes in this. That includes myself, that includes Ross, that includes a lot of our loan committee, and our upper management has a big position in this fund, something that we tremendously believe in. We had another excellent capital raise quarter. I think a lot of that has to do with those maturing CD rates, and also people are sort of looking to rebalance, and they've realized, hey, this is something that is safe. Marshall Reddick is doing exactly what they said they were going to do. And we had very few redemptions, right? But redemptions are a part of running a successful fund like we are doing, and getting the capital back. It is available to you when you need it, whether in partial or full. So we did have some folks, about 500 grand, that exited as a part of the second quarter. So we talked about as well the 1.68 million in net income, and I always love to share that more than 50% of that income is staying in the fund and being added to their capital account and reinvested into new loans, into earnings, and to generating profits in the bottom line for your individual capital account. So we love referrals. Don't be stingy. We'd love to talk with your friends, family, colleagues, all those kinds of things, right? I'm talking to my neighbors all the time. I'm talking to kids out at the Long Beach Little League field, and other sports that my son and daughter are participating in. And I love telling people what I do or what I'm investing in, all those kinds of things. And you'd be surprised how many clients you can pick up by doing that. And I'm sure that your friends, family, and colleagues all are asking you the same question. So we'd love to talk to them. If you had a great experience with us, as I suspect you did, again, we'd love to hear from those folks. Please feel free to make a warm introduction. I'll chat with them. Vince will chat with them. Kaylee, any one of our knowledgeable and professional advisors would be happy to do so. Okay, what's ahead? Not a lot of change here. So we're still going to continue right on our methodic march towards 100 million. We're going to continue to be right in that 8 to 10% earnings range, a lot dependent on your capital account. We're going to grow the team. As I mentioned that, we are hiring and hiring more, right? So business is good. As I mentioned, we've got a team of 15 now. And the cool part about that is that the 5 staples on that team have been with me going on a decade. Each of them are going to be approaching a decade of experience on my team, right? So there's just nothing better than the experience that comes with working with a team for that long. We just know what each other are thinking all the time. They know the types of loans that we are looking for to make. They know the types of borrower profiles. They know the types of assets, right? And so we're teaching those new folks that are coming in exactly the same way. So again, we're looking for good people. If you know anybody, we'd love to talk to them as well. The software could always be improved. I'm always taking feedback from folks in terms of the portal. Know that your portal does have an online app as well, but we're talking to the developers with Appfolio and constantly trying to get them to add new features that will make all of our lives a little bit easier. As I mentioned before, the REIT, that's sort of been on hold while we're starting to wait out. One of the biggest benefits of that real estate investment trust is that 20% QBI deduction. Now that that's been extended, I think you're going to see it in 2026. I truly do. Right? So stand on board. That's going to be a huge benefit to everybody. That will also have some good tax implications, and that will also block UBTI in the event we choose to bring on leverage. So you, as a self-directed retirement account investors, will still experience no UBTI and no need to file a 990T, even if we do bring on leverage. Okay, but we'll certainly let you know if we're going to do that, as we want to make sure that that is something that is disclosed. And then, of course, audited financials, right? I think that just gives everybody peace of mind. Something I've learned about audited financials is that it's not only about your accounting, but it's about stress testing your portfolio and your loan to values and the types of loans that you make. So they're going to take a deep dive into our loan tape. I mean, it's all right there for you guys to see right on that website we talked about, but nonetheless, right, that is going to be, I mean, it's a ton of work, don't get me wrong, but it's been a great learning experience so far working with the CPAs that are going to handle this. And I think that this is just going to be the next level of Marshall Reddick Mortgage Fund. I'm excited. Okay, so if you're an existing capital partner and you're looking to increase, again, I think it's a great time to do so. We'd love to have you do it. You can always email us here at the group email that we talked about. And if you're newer and you have more questions and you're not just ready to dive right in, you've already got your portal set up and all that, use the QR code again to connect with somebody here at Marshall Reddick or call Vince. right? Vince told me to say from him, hi to everybody. He was on the call outs today, so many of you probably spoke to him. Vince is awesome. He's been here again almost about a decade as well, and is one of those guys that's just a staple on our Marshall Reddick team. He understands the nuances of our fund and our overall business, and he's in a lot of those meetings that we have from a loan committee level and in terms of accounting and all the different management that goes into this on a regular basis. So utilize him as a resource. Again, that is the URL. Use this. It's updated on a regular basis, and it's perfect for those that are existing capital partners that are looking to stay in tune with what's happening, or for new investors that are just getting started trying to figure out, is Marshall Reddick Mortgage Fund right for me? So we're here at time, folks. I appreciate your time today. As always, again, it's my pleasure. It's my sincere thank you to you guys as the capital partners for making this all happen. None of this happens without the capital. So again, we appreciate you. Look forward to the opportunity to be of continued service. Bye now.